We want to talk about the marketplace issue with business owners, then we'll do some introductions of our businesses. Then we'll talk about exit and growth planning and a 6-step process that's worked for 15 years. And then give you some thoughts on how you can help your business owner prospects and clients. I'm going to start with some survey data, and I like presenting data. I think a lot of attendees like to learn about data and statistics, and they also like to hear stories to make it relatable. There was a survey done a number of years ago that showed that 84% of business owners stated that the sale of their business or the monetization of their business was important to their retirement plans, all that wealth that was trapped in their business. But as you may or may not know, and we're here to raise the awareness of this, the business owners generally do not plan for this occurrence. They treat the sale or monetization of their business similar to how they might handle a home or a commercial property, right? Well, a few months before I decide to sell it, I'll clean it up a little, give it more curb appeal, and then we'll just find some buyers, right? And that's rarely why it happens. In the same survey that was asked of so many business owners, 500 in this case, why you have not prepared a formal transition or succession plan, you can see all of the different categories here. It's too intimidating, too time consuming, the thought of it being the end, too complex, not adequate advice or tools. This all sets the stage many years ago, but the number one, of course, is owners feel invincible, it's too early. And that was the predominant answer, no matter whether they were asking somebody that was under 40, 40 to 50, 50 to 60, or over 60 years old. They all said it was too early. And the reality is, we've all been longtime advisors. It literally is never too early to start thinking about this, but it certainly can be too late because it takes time, and that'll be the essence of our presentation. We've worked with clients for years, many years. We have case studies on our website that span 12 and 14 years that comprise planning, consulting, value improvement, growth planning, growth execution, and then the exit transaction. And then frankly, the post-exit, what happens then with the liquidity and what happens with the company. Those that plan ahead get better results. Most business owners and many advisors do not know that they can start this planning today. They don't know the resources. Just a few testimonials. A business owner who exited in 2008 said he spent 5 years wandering down the exit path, getting fragmented information from advisors, from people who were trying to help us, right? But they weren't getting holistic advice from anybody. This business owner spent 5 years and $250,000 through trial and error. And that's how that owner got his education, made a lot of very expensive mistakes. What Steve and I are going to talk to you about is a holistic approach to doing this. Another business owner, to understand the mindset, right? Business owner we helped with a successful exit many years ago. He's saying, he was informed by the personal aspects. He watched his father kill himself working 4 jobs. He didn't have anyone to throw the baseball with. Watch him literally put himself in the grave with heart attacks. He told his wife when they were married, when I'm 55, I'm done. We will have succeeded in life, and I plan on retiring when I'm 55. Now he exited and he said he doesn't know how he had time for work. That's a successful exit. Somebody that had the vision that they would exit by a certain date, built the business around it, and then had a successful enough post-exit fulfilling life that they didn't even know how they found time to work, right? That doesn't happen on its own. There are many, many cases where the exit fails or the transaction succeeded, but the owner regrets or falls into, a state of boredom or even worse, because they don't have the same things that are fulfilling them, like running a business successfully, because their identity is tied up in it, and it takes a while to undo those knots, right? Another reader said, if there's anything I want your readers to take from my case, is I really do believe you should begin planning your exit a decade ahead. And I think that's true. What isn't true is the fact that business owners just simply don't do it. Just some other statistics. Publicly traded companies, there's about 10,000. There's millions of privately held businesses. There are many things that flow from this. But if you look at this chart of census data, there's over 25, 26, 27 million privately held businesses, but very few of them get to 500 to 1,000 employees, and most of those are publicly traded. There are millions of businesses with 1 to 19 employees, businesses like FAZ, businesses like Beacon Hill and IEPA that fall in that category. But look at the drop off when you get to 20, how difficult it is to get to 20 and 99 employees. There's only 500,000 versus 5 million. And there's greater levels of complexity that have to be navigated. And then there's even fewer companies that are 100+ employees. There's a tremendous amount of opportunity on an absolute basis that's out there. But on a relative basis, there's not many companies that can grow to the point where there's a lot of wealth in there. But even though there's not a lot on a relative basis, there's hundreds of thousands that need our help, what we call the lower middle market. And many of these business owners are aging with the boomers. The wealth in this country is mostly created through ownership of businesses. This is a chart that correlates household wealth, 1 to 10 million, over half of those households built their wealth through a privately held business. If you become worth 10 to 50 million, you start entering ultra high net worth. More than two thirds of that wealth was created by privately held business over 50 million. And we're dealing with a few clients right now that are more than 50 million. 86% of those households created that wealth through private business ownership. The challenge is the private business is illiquid, unlike the other assets that they hold: stocks, bonds, cash, and real estate. And that's where we come in. We help solve for the complexities and help owners navigate the complexities of diversification, of moving illiquid wealth to liquid form, transitioning the company, and helping them personally achieve their goals. At a high level, just a final point here before we get into introductions, market timing becomes a big factor in this total equation, going back to the point that we'll repeat throughout the presentation of why owners that start early have a huge advantage in this process. Very simply, every 10 years or so for the last 4 decades, the cycle that followed the economic cycle the deal cycle was following the economic cycle. The beginning of the decade started slow. The middle of the decade was robust. The end of the decade brought a recession. In 2001, the recession came late. It's precipitated by the tragedies of 9/11. In 2008, in the same decade, the global financial crisis showed up a little early, and that put us in a deeper hole that took longer to get out of economically. The chart indicated that in 2020, another recession was coming. I could speak on this point for a long time. We educate our owners about these points, but COVID showed up on schedule and created a short recession, which was a health crisis, not a financial crisis. And I think the jury is still out, so to speak, on whether we delayed that recession or avoided it. It's really hard to read the tea leaves. We're truly in uncharted territory with all that stimulus from the government and the relatively quick arrival of a vaccine. We're still sorting that out between supply chain, inflation, Silicon Valley Bank, issues that have to be figured out. However, what we can say is that business owners that have the timing in mind, have the flexibility to work through different cycles, can be better prepared because market timing is a key factor in valuation and everything else. When we look at an exit plan and a growth plan, we look at the owner's personal goals and their readiness, the company's readiness, and the market readiness. Steve, that sets the stage for kind of what the market issues are, and maybe turn it over to you for some of our introductions.
Sure. Thanks, John. Good afternoon, everybody. So John's been talking about exit planning. He's referenced holistic approach a couple of times. And what we mean by that is it's an approach where we look at both the personal goals and needs of the business owners in conjunction with their business. And many times we go through and try to determine where they are with assets outside the business and where they need to be ultimately in terms of the total nest egg they're going to need to be able to enter the next chapter of their life comfortably. And through this process, we come up with what we call a value gap. And that value gap needs to be filled by the value of the business ultimately, based on how they decide to transition it. And we work with them to try to determine how they can fill that gap and move on and start to begin enjoying the next chapters of their life. But many times what we're finding, particularly with the baby boomers, is for various reasons, they're not ready right now to leave their business. So we have to change our hats and to allow them to, have a plan on their terms. We need to move on into an area that's called growth planning, which is our next slide. And growth planning is really playing off of the techniques that private equity groups have brought to bear in working with companies. And we're going to talk about that in a little detail, particularly in a case study that we've got for you later on in the presentation. But it's really working with them so that we can identify value drivers within their business, where they need to work on these drivers to enhance the value and really increase the value of their business so that it can be transferred at a point that does make life work for them. So it's the value that they need to succeed is what we look to gain through our growth planning process. And John and I have created this exit planning alliance amongst our various entities. FAZ brings to the table valuation and growth consulting, as well as exit planning work that I'll talk about a little bit later. Many of you may know about the forensic work we do, but we're gonna do a deeper dive into the advisory work that we provide today. And also we've got a couple entities that John has established, the International Exit Planning Association, that's a membership organization that we'll talk about, as well as Beacon Hill Equity Group, which is an organization that provides transaction advisory services. If we're working with a business owner and they decide that their option for exit is to sell the business, we can work with them through Beacon Hill to help them transact. So I've been doing work with business owners. It says 35 in the slide, but sadly it's over 40 at this point. I've been a CPA since 1982. Started out my career working solely with business owners, helping them run their businesses, helping them with their financial statements and tax returns. Spent the second half of my career in the forensic accounting space. I have helped manage CPA firms. I was involved in leading the merger of two $20 million firms back 6 years ago. We ended up becoming in the top 100 in the country in terms of the size of our firm and the capacity that we brought. I enjoy working with business owners. So I am in this chapter of my career, I've transitioned somewhat away from the forensic work into the exit planning transaction advisory space and working with John in this alliance. And I'm very excited and charged up about where the future is heading in that area. So for FAZ, many of you may know from Charlie and the Meeting Point group that we do provide forensic accounting, investigative work, fraud prevention, economic damage, as well as business valuation in a litigation environment. But you may not be aware of the advisory work that we're going to talk about here today. We're really looking to help business owners, grow their businesses and achieve their life plans. And we do that through our exit planning and transaction advisory work.
Thanks, Steve. I'll introduce the two companies that I own and run and how this came about. Again, my name is John Leonetti. Had a lot of education. I'm an attorney. I don't practice law, so I'm in good standing with the state of Massachusetts. Now I'm practicing. I got a master's in finance after my undergraduate in Providence College. And I created and taught an MBA class on private finance. It was a first of its kind that led me to publish my own book 15 years ago. Actually, this October will be 15 years. In October of 2008, as many of you will remember, the global financial crisis started with Lehman Brothers challenges, and then it expanded. So not a great time to be publishing and spreading the word on exit planning. Business owners were trying to, survive a crisis, a financial crisis. So during that time period, while business owners were not exiting and were not taking growth consulting advice, they were in more, emergency repair triage mode, as many of us were. We created a training company from the principles in the book that's still going today. It's the International Exit Planning Association. Some of you may have seen it formerly as Pinnacle Equity Solutions. We rebranded to the IEPA, and we offer training to advisors and certification, thought leadership. We run 2 conferences. We do monthly educational calls, and we built a series of tools. And during that time period, we were very focused on getting trusted advisors to take the class, take the training, use the tools to go ahead and help their business owners. We're still focused on that today as an association. That's 16 years running. We're in our 16th year of doing that right now. From that work, it brought me back and started connecting with Beacon Hill Equity Group, which is a sell-side transactional advisory firm that does things a little bit differently, and that's what this presentation in part is about. We do sell companies. We'll give you a whole range of those in a case study, but we like to think we do it a little differently, which means we work with Steve and other advisors to bring a holistic approach. This alliance is about bringing a holistic approach to a sale transaction. And the analogy that I like to use is that 30 years ago, 40 years ago, stockbrokers selling stock to investors and making commissions was the norm. The market changed and started embracing financial planning, then complex financial planning, then wealth planning, then certified financial planning as a designation, as the main designation, all the way up to family offices and ultra high net worth platforms that are very prevalent today. We believe that over the course of time, business owners will also be seeking out more comprehensive advice. And in that respect, we think we're ahead of the market, and our relationships, our results kind of show that there's a segment of owners, and that I like to use the expression, they want one throat to choke. They want one place to go, one alliance, one partnership where they can get planning, consulting, and transactional advice. That's very rare in the marketplace today. Our firm has been formally engaged over 100 times. We've advised on almost $1.5 billion, in illiquid equity. We've created, we're on a path to almost 400 million in liquidity through our sale transactions. And we'll give you a listing of those towards the end as a sampling, and you can see some of our case studies on beaconhillequitygroup.com. Our 3 companies, the training company has thought leadership tools and a national network. There's 250 members of that association. FAZ has the consulting, the planning, the research, the modeling, and then Beacon Hill has a transaction advisory. So when you put the 3 together, you have a very powerful ecosystem and network and resource, abundant firms that can address and have seen the challenges of hundreds of business owners. And when we get to the cases, we'll walk you through some samples of how that works, what size businesses we typically work with, and where you might find business owners that need this type of help. What I'd like to do is run through our third agenda item, Steve, unless there's anything else on the intros, and talk a little bit about this process that has worked very well for the last 15 plus years.
Yeah, I guess, John, just one point on the intros. It's actually the International Exit Planning Association. That's where John and I got introduced to each other and met. I went through John's training back in 2015 and became a certified business exit consultant. And that's really how our relationship started. So just to add that to the conversation.
Yep, good point. Good point. Thank you. We were at our conference this past November in Boston, and Steve and I struck up a conversation, and I said I would very much enjoy in the new year in this 2023 an alliance with you and doing this type of work. And it's a privilege to be here. I know how hard it is as a practitioner to earn a business owner's trust and to sell advice and to be compensated for that, to go through training, right? And to get command of a body of knowledge and then have the market value that. So when you do that as an advisor with business owners and you invite us in to help solve problems with you for that case, that is truly a privilege. And that has been our model for 15 years, to respect those relationships and offer these services to help support your clients. The way that we do this is laid out in the Exiting Your Business book. And I am happy, it's never far away. I'm happy to send a copy of the book to anybody on the webinar. If you email us, Charlie, Steve, myself, to send it along so that you can read it and go through it. The core message in the book to business owners is twofold. Number one, there are steps you can follow to organize this process. And number two, there are options available to you other than just selling. And these are two very important messages that Steve and I have developed command over and have experience with to deliver that have stood the test of time. And I'm just going to give you a quick run through to give you a sample of it so that you can see how it's worked for thousands of business owners, across our association and ones that we've worked with personally. I'll go through each of the steps and then give an example of each step, a few talking points. So first, we want to help the owner establish their business and personal goals. Then we want to measure their readiness, financial and what we call mental. From that, we want to help them identify what type of owner they most resemble. We want to teach them their options, have them understand the value of those options, and then get into execution, some of which is increasing the value of the business. So if we look at goals, what do we talk about with business owners? We ask, what do you want to achieve with your exit? What if you could wave a magic wand and have a future, right, that includes an exit, what does that look like? Oh yeah, Charlie said, if you have any questions, please put them in the chat. We're pretty good at multitasking and picking up questions. So please ask questions as we go. We would like to make this interactive. Thank you, Charlie. And we will leave time at the end. We talk to business owners about what they want to achieve. And the reality is most owners, start with, I just want to take 6 months off and then I'll figure it out. I want to play more golf. I want to spend more time with my grandchildren. Those are leisure activities. Those are not fulfilling activities that a business owner is used to, particularly if they have a successful business. So the psychology there is important. These successful exits are the ones where owners are moving into something new. They understand their personal goals. They understand what they want to achieve. Typically, it's have the company continue on without them. and to have a little more freedom in their lives. They develop a lot of 5-year plans. They say, I want to work 5 more years, and then it just rolls into another 5, another 5, another 5, because that's easy to do. Time stands still in businesses, right? For business owners, especially when you go through a global pandemic and you're just kind of happy to survive. And by the way, that 10-year transfer chart suggests that business owners today are facing the probably the recession in the beginning of the 90s, after 9/11, after 2008, 2020 and COVID. They've seen 3 or 4 potentially catastrophic economic cycles. And the question for some of our older owners is, do they want to hang on for, you know, the next one, or do they want to develop an exit? Part of the goal setting process is asking who they think they want to own the business next. If we start with the assumption that the business will can carry on without the owner, the question is, who's carrying it on? Is it a competitor? Is it an investor, current employees, other owners, co-owners, family members? That's part of the goal setting process. If the owner could wave a magic wand, I see somebody wants a copy of the book, no problem, we'll get that to you. If somebody could wave a magic wand and say, hey, I'd really like to have my employees take over the business. Okay, let's talk about that. That's the first step, is try to identify that. And the range of answers is wide, right? Some people say, I just want to go out and get the most money, turn over the keys, and head to the Bahamas for a little while, or to my vacation house. Others say, I'm really concerned about the key employees. I'm really concerned about the culture. I'm really concerned about, you know, maintaining what I built. And the highest price doesn't matter as much as that. So we have to get to the priorities. What are the goals? What does this owner want to achieve? And most of the time, they haven't thought about this. And financially, have they, as Steve said, thought about the financial aspect, how much money they need to live the life that they're living? This is where we start with financial readiness, step number 2. Financial readiness and mental readiness go together to try to determine where an owner is today. This is our process. It's a process we teach and certify people on. It's a process we can do alongside you with your clients. What's the after-tax income you want or need during retirement? Most owners don't know their actual needs. Why don't they know their actual needs? Because when they go to the gas station, or they go, you know, on a trip, or they do any variety of things, including sporting events. I'm going to the Bruins game tomorrow night, right? Is that a corporate expense? Is that allowable, right? It sort of blends together. I'll definitely be mixing business with leisure, right? What does that cost me if I don't have my business? Whether it's deductible or not, there's a pool of cash to pull from. But if you're retired and you don't have that, or you sold the company, your lifestyle needs change. You can't do pre-tax deductible spending the same way. Things are spent with after-tax dollars, right? So most owners need this analysis. And that's their personal needs analysis and the value gap that Steve mentioned. What do they have in savings? What do they need? For example, if a business owner lives off of $500,000 a year and is comfortable with a 5% investment return, without invasion of principal, they need $10 million. Let's assume they have $1 or $2 million saved. So they need 8 or 9 to fill that gap after taxes, right? This is Steve's point. If the business is only worth $5 or $10 million, we might need to grow that value. Most owners don't want to reduce their lifestyle. It's a conversation, it's a discussion, it's a process that we take the owners through. This is about a lot more than selling the company. It's about helping the owner diversify and talking to them about different ways that they can diversify, and then asking them when they want to do this. A lot of when they want to do it depends upon how involved they are in the business, how much they enjoy the business, and how much they want to keep going. So many of you were sent a survey link called the Business Exit Readiness Index. This is how we come back to the IEPA, the association that creates these tools. And this is a 10-minute assessment that you can take to give you a sense of how to start this conversation, or how we would start the conversation with a business owner. It's 20 questions, takes 5 or 10 minutes, and the owner gets their results instantaneously. Here's a sample of some of the questions. In the interest of time, we'll just kind of leave it to you to take the survey, but you have 10 questions on financial readiness and 10 questions on mental readiness. And together, that helps the software help score the business owner as to what type of owner they are, using our methodology of financial and mental readiness to help them self-select into one of 4 types of owners. Now, after about 9 years of having this survey in the market and having more than 3,000 business owners take the survey, what the market tells us is what we've known for a long time, but now we have the data. The vast majority of owners have a low mental readiness. So on the horizontal axis, we have mental readiness. On the financial or vertical axis, we have financial readiness. When we add these up, mental readiness is low. A vast majority of those have low financial readiness. Most owners want to stay in their business and need to grow the value to achieve a successful exit. And that's what we'll talk a little bit about growth planning, give a case study, and take some questions. We just wanted to show you some of the inside look at some of this process, because once an owner identifies inside this quadrant chart, we can then talk to them about the exit options that apply to them. And that's our 4th step, is learn their options. What type of owner you are leads to the 5 different types of options. The sale to a third party, an investment with private equity, an ESOP, a management or co-owner buyout, and gifting. And this really comes down to the goals. Do they want to get out now? Do they want to stay and continue to work? Do they want to grow the value of the business? Are they ready to move on and simply want to look at other options that allow them to do that? These are the conversations that we have with owners, and have had hundreds of times, in order to help them understand their goals and gain some clarity. From here, we want to know the value of the exit. This is where FAZ comes in particular, with the valuation background, the ability to help business owners understand the different values for the different options. So again, there's a 6-step process here that ends with the execution, right? We want to know the value of the exit and whether we need to increase that value. And then we need to know what else we have to do. There's a whole litany of things that happen regarding taxes, estate taxes. We have to look at deal structure. We have to build an advisory team, understand legal agreements. Steve and I will make some points in the case study before we wrap up. The execution is important. In today's market, there's a lot of business owners that have businesses that are highly dependent upon them. Part of our initial discovery with a client is taking another survey called the Owner Dependence Index. Nationally, the 1,000 or so businesses through these surveys are 53% on average dependent on the owner for the running of that business. That's pretty high, right? For an owner that wants to transition a company, more than half of the functional areas of the business are dependent upon that owner. So there's issues, right? The ODI looks at 8 different functional areas. If you're interested in taking that assessment, we can send that along as well. Essentially, what we find in the market is there are 2 categories of owners. There's one that's ready to go today, and there's another that wants to be prepared in the future. Of course, there's a category that doesn't know anything about any of this, and we're hopeful that raising your awareness will help reduce that population, and you have a solution and you can help them. But in the second category of owners, they typically need to do some kind of growth and value enhancement to increase the value to meet their goals. And Steve, did you want to talk a little bit about the growth planning and walk
Yes,
us
I'd be
parts of
happy
that?
to. But yeah, before I do that, just a side note on the Business Exit Readiness Index. I have noticed, I've got notification that probably a handful of people have filled out the survey and have probably gotten the reports. I'm happy to talk to all of you about those reports if you want a little more insight into them, and if you think you've got some clients that might find it useful, please feel free to share it with them. And I would encourage the rest of the group that may not have taken the survey yet to go ahead and do so, because you definitely will learn something meaningful about the process by just going through that short survey and seeing the results. So with that, let's get into some business value and some growth conversations. So the function of value really is cash flow, which is another word for EBITDA, earnings before interest, taxes, depreciation, and amortization is really just another form of cash flow. So it's all about the cash flow of the business and the risk of that cash flow, or the expectation for that cash flow to continue into the future. So when we work with business owners, we want to establish what the baseline is, where they are, how much value they have right now to currently fill that gap we've been talking about to reach their personal goals. And there's a couple ways that we can work with them. One is what we call de-risking. And one of the biggest issues we run into with closely held owners is what John was just talking about, ownership dependency. There's a huge risk of that future income stream going forward if the business were to be managed by another individual, because it's so dependent upon the existing owner. So we want to work with those owners to make the business more transferable, which in turn de-risks the business and will provide for a higher multiple upon a transaction. So that's one way that we increase the value. And the other one is just to work with them from a growth planning standpoint to increase the future expected cash flow. So it's the function of those two areas that really have a multiple effect in growing the value of the business to help owners close that gap that they may have. So that leads into our another survey that was developed about 3 years ago by John and his International Exit Planning Association. It's called the Growth Planning Index. It's very similar in structure to the Business Exit Readiness Index, but it really measures a business owner's commitment to the planning process, how invested they may be in growing the company, or maybe do they just want to maintain a lifestyle. As you can see, when you fill out this survey, you get kind of classified in one of these 4 quadrants. We're finding that many owners, like 20%, are looking just to maintain their lifestyle and strengthen the business. They just want to make it easier to run. They're not maybe focused on exiting the business at this point in time. They just want to make it more comfortable for them. And then the lower right, they really don't want to do the heavy lifting that's needed to grow the company and increase the equity value. They would prefer to just sell the business and have somebody else do that, or exit it to their management and have somebody else grow the business. The top two, there's a lesser percentage. It's pretty much half of what's going on the lower quadrant. So they're really looking to have a growth focus and achieve a successful exit at the end. What this tool does is it allows us to understand where they are in their thought process with regard to equity planning, and allows us to help determine how best to work with them in growing their business. And in the next slide, we'll see that it also allows us to focus in on what value drivers, the value drivers that I was speaking to a few minutes ago, what are the most important drivers based on what their thoughts are about their mental process around growth and building equity. So it kind of builds a roadmap for us to work with the business owners and help them create the growth that they really need to have a successful exit down the road. And
So
this
just
is
jumping
another
in there,
survey that we're
Steve.
happy to share with everybody on the call.
Yeah, so along with the book, if you want to see the other assessments, we're happy to send them to you just as an example. But this gives us a very good viewpoint and vantage point and does a lot of discovery on the client, what they're trying to achieve. In particular, the case study that we'll talk about for a few minutes, our clients took all three of these surveys and allowed us the privilege of doing some growth consulting and handling their exit transaction for them.
Right. And we do have some assessment tools that are built around growth so that they help us measure where a particular business owner may be in those various drivers. So it gives us a roadmap to help them grow a business based on the drivers that need it the most.
And we come full circle during execution, right? So a business owner needs $10 million, for example, to maintain their lifestyle. If their business is worth $20 or $30 million, most likely, we can check that box and start talking to them about ways they can monetize or do an ESOP or do an MBO and extract value from that business. If the business is worth 5 or 10 million, they need to net 10. Well, in order to get a lifetime supply of income, they might need to increase the value of that company. And leaving some time for Q&A, it brings us to just a sampling of recent engagements. People typically ask, what size companies are you working with? Right now, we're working with Steve on a number of deals, the one we'll talk about in particular here, but we've got a $57 million fabricator plastics specialty business that should close in the next 45, 60 days. We've got an HVAC company, very hot space for a variety of reasons. We just launched that one this month. We've got a specialty vehicle company that we're preparing to launch in a few months. And then you can see that the range of business values is anywhere from $6 to $100 million, with 100 being the outlier. The vast majority are between 10 and 50 million in value. For those that are more numbers oriented, that comes down to about 2 million to 6 million or 7 million in EBITDA, 2 to 8 to round it up, 2 to 10 if you're really going to round it up. These are businesses that were typically founded or even purchased a small business by the founder or the subsequent owner. The owners grew it and got to a point where they had enough of a leadership team and enough business momentum to get the value, but they typically need something else to get to that next level. And there's either a private equity group or a family office that comes in to support that growth, or an industry buyer, or an internal. We didn't list a lot of the internals, but we've done a number of ESOPs and a number of MBOs as well. But we wanted to give you a sense of size companies that we work with in terms of EBITDA, and the corresponding revenue would be about 10 to 100 million in revenue, right? Businesses that reach a critical mass that typically have leadership teams that have enough wealth that it needs to be assessed and managed. They're large enough so that they'll have some attractiveness in the market, typically to create more options. And typically there's a leadership team or some family members that the owner wants to navigate and look after. We want to take any questions, please submit them. I see a few in there. Let me take a quick look. Okay, we have a few people that want to see the berry, that want the book. No problem. We'll take care of that. But Steve, we can talk about a case study right now where we're in the healthcare space, and this is a niche business within the healthcare space. We can go into a lot of details. We have over 500 hours into this case already. We're working on this with FAZ and with Steve. There are two owners that are related. They are parent and child. The parent was the founder. The child is a very talented entrepreneur, right around 30 years old. The parent's closer to 60. So they have very differing personal goals. That's the personal side. On the business side, they have a business model with a proven, profitable, scalable niche with recurring revenue. Those are big buzzwords. Scalable, profitable, niched, and has recurring revenue, right? And it took them many, many years to develop this. So when we met them last year, the parent was ready to move on, and wanted to sell. The child was just seeing the fruits of their labor and innovation and changes evidenced through the business. So specifically last year in January, they did a hard cutoff on taking insurance, became cash only. That was a massive accelerant inside this niche because it removed the obstacles created by insurance companies around reimbursement and paperwork and submitting invoices and that type of thing. They just went to cash only for their treatments. Their treatments are relatively inexpensive, a few $100s a month. So this wasn't a surgery center that went cash only. This was a business that was niche that could do this. And as a result, their growth started going a lot quicker. What happened in this case, that's evidence of the type of business that we have, is we were introduced to them and we asked them what they're trying to achieve. Okay, we identified right away through the survey tools that the readiness of the two business partners, parent-child, was very different. The owner dependence was similar, but they each had different roles in the company, but there was a lot of dependence on them. And they both wanted the growth, but the difference was the parent was not committed. They were closer to retirement. They had built a career, in this case as a doctor, and had a passion for actually a nonprofit charitable endeavor. This is a very, very special person, the doctor, who gives away their time, travels the world, and offers free services, is literally saving thousands of lives every year with what this doctor does. And that doctor wants to do that, but the child wants to grow the business. So if we were only a sell side group, we would say, okay, well, call me when you're ready to sell. Instead, we got into a strategic planning conversation, asked all about the growth potential of the business. Could they franchise it? Could they scale it? What kind of infrastructure do they need? And so on and so forth. And we were able to talk to them about the things that separate entrepreneurs from professional investors. And we want to just spend a few minutes here towards the end to put our case study into specific examples. And Steve, we can go back and forth here, but on the left column is a professional investor, in our case, a family office that is investing in this space, came into our world, right? And this client was in the middle of growing the value of the business when this acquirer showed up. This acquirer has experience in their space taking companies public. So they have a totally different perspective than the entrepreneur. And Steve, just jump in on any of these, but when we talk to this buyer, we're now negotiating the sale of this company, this merger with this buyer. And why is our client choosing to do that, right? Because our client, when they think about exit, they see that this professional investor knows how they want to exit before they make an investment. Our client did not know that. They were just doing their job and built a company out of it, medical services. The professional investor knows the value and how to increase it before they put their capital in. Our client didn't know the value of their business or what, to Steve's point, what drivers would increase that value. Our professional investor looks at capital as a commodity. These are dollars to invest and to grow. Our client looks at it as their money that's funding their retirement and their lifestyle. Our professional investor sees equity as a way to align interests. Our investor has put equity and stock options into our plan with our clients to align interests and incentivize them along with profit sharing components. Our clients just look at equity as theirs. It's between parent and child, and it allows them to control the business, and so on and so forth, right? We just know that privately held business owners want to grow, and they're capable of growing beyond where they are today, but typically hit a ceiling at some point. And that's the point at which our combined businesses allow that conversation and that engagement to transition into a growth and consulting assignment to an investment banking search for an investor to come into the company assignment, because the owner has reached a point where they don't have the experience that the professional investors have, and they're starting to make very expensive mistakes in growing the company. That's when most owners that are going through some form of growth execution, growth planning, realize that it's a lot easier said than done to increase the value of their company. Now, along the way, we do make substantial increases to the value of the business, but the most important thing that we typically do when that happens is we present a growth plan that we've designed to the investors to show that there's a plan for growth, and the clients simply need experienced investors and capital to align with that plan to help execute it. And those are some of our most successful cases. This one is ongoing right now. In fact, Steve and I were negotiating the letter of intent yesterday. In another hour and a half, we'll review that with the client and legal and send it off to the buyer, hopefully to prepare for execution either by the end of this week or early next week, go into diligence and get to a closing sometime in May. So a number of folks on the Q&A have asked for the book, no problem. They've asked for the Berry and the ODI surveys, no problem. And then somebody offered that some particulars, concrete company, 2 owners, we know the space, mid-60s, CFO, we started and stopped these conversations. How do I get them on a defined plan to keep moving consistently? Okay, so with just a few minutes here, what I would tell you is conversations start and stop. That was our opening quote, right? That owner from 2008 meandered, wandered down the exit path. It sounds like that's what these owners are doing. They're wandering. Here's a seminar here, here's an advisor here, here's a piece of information over here. It's complicated. What I would say to you, and kind of the theme of today's presentation, is one of the ways that you can get them moving forward consistently is show them that there's a process that stood the test of time for 15 years. And then give us a call, and we're happy just to have a conversation with them, give them the surveys, have them start thinking about this, show some organization around it. And then that helps drive consistency. And you can reach out. Steve's the best initial point of contact. But you could always reach out to me as well at the contact information here. I appreciate you offering this in terms of the challenges that are faced. What I would tell you is that the marketplace is not set up very well to handle the needs, the pre-sale needs of owners. If owners know they want to sell, there's a good group of easily findable and identifiable investment bankers that can help, execute a sale transaction. What there's significantly less of that is developing, part of the awareness raising of this webinar, is groups like Steve and ours that come together as an alliance to do all of the work on a pre-sale basis. And about 95–98% of the time when we do that with clients, those clients award us the privilege of representing them to the marketplace via sale because of the trust that we built and because of how much we've learned about the company. We do not bundle those services as a requirement. We simply engage in conversations, get paid for our consulting and planning, and then we put ourselves in a position with the client to educate them on what's available in the market. And then they oftentimes will tell us, why don't you go ahead and take us to market and help us execute. And that's what happened with our niche healthcare business as well. I know we're coming up on time. We're a minute over. Steve, I kind of got rolling here. Anything
that's
else
great.
on your
That's
end?
great.
We're
I
just at the hour.
Just for John, the CFO, I would encourage you to have the owners take the very assessment that you have the link to, and we're happy to have a conversation with them. I'm happy to have a conversation with you on the side to understand what how they've started and stopped in the process to get a better handle on that, and happy to try to help you with the conversation going forward. And appreciate everybody's time today. We're pretty excited about the alliance we've created around these service offerings and the need in the marketplace for them, and look forward to working with all of you and your clients going forward.